not, getting everything from you is by putting at least 20-25% down. So the belief and the expectation that what happened last time was a foreclosure crisis, there's no foreclosures out there. They don't exist. So that was the biggest part of that meltdown. So that would be the conversation I would have with them.
In 2000,
Almost 100% of all the products that make that possible are illegal today anyway.
yeah.
So you can't have that same situation.
2008, that was a credit crisis. It
Well,
wasn't,
that's
it wasn't
where I
a
come
housing
back
crisis.
and say, everybody's got equity
Yeah.
now.
Yeah.
Why would they walk away if they've got $50,000 or $100,000 in equity?
Tell them turn television off.
But
Yeah.
And that's a good argument too, because there is more equity in property now. A lot more.
Yeah, that was a credit crisis. Like you said, if you could fog a mirror, you're gonna get a mortgage, and it's just not
I
that
could have
way.
gotten a mortgage for a monkey.
Right. And a lot of those, those exotic loan structures went away, for the most part. Some of them are coming back in, and we're gonna talk about that here in just a little bit, and hopefully that'll help you explain to them and how to overcome that objection. Good question. So, you guys have been in this probably for a little while at least to see, or you know that real estate is cyclical. Here we are, we're in a cycle, right? Bad news is experts say that we're in stage 3. I disagree, I think we're in stage 4. How many of you have seen housing prices fall in your market?
Yeah.
Frank?
Sure, yeah.
15, 20%.
Have you seen values fall?
No.
Difference, right, in prices and values?
What I want versus what I can get.
Right, right. So yes, prices are falling, values are, for the most part, holding steady in most markets. So look at it that way too. They were selling for way too much. Now they're just dropping, but they're dropping to what they should have been.
Right.
Good news, told you I'd bring you good news. Some experts are still saying that, and this may help you as well, is that your values are still going to either hold steady or still increase at least a little bit per year, but not crash. And that seems to be the consensus. If we're in stage 4, just beginning stage 4, what's next? Stage 1, so we start all over again. So stage 1 is good. People are starting to get more confident. When prices and rates go down, sentiment becomes optimistic, and we do it all over again. So it's a really, we've been in these first 2 stages for quite some time. For how long? It's been years. So it's cyclical, it's gonna happen. The good news is that stage 1 is coming. So think of it like that. Here's what's coming in when we come back to stage 1. You've got 90 million millennials that are out there between 26 and 41, Gary's age, shopping right now. I'm not sure why they laughed at that. These are the ones that are in the market, primarily looking for homes, your first-time home buyers, all that. You've got these guys coming behind them. So if you're getting discouraged and want to bail, don't, because this is coming down the pipe. These guys, this Gen Zers, aren't going to even remember 2 and 3%. Again, how quickly did we forget that 5.5 was pre-COVID? So consumers do forget. And suddenly the new norm is going to affect these people. Now they may talk to their parents and get a different story, just like I talk to mine and my kids talk to me and get a different story. But it's the same thing. So hang in there. Don't get discouraged. This is coming. You've got all these guys out there. So let's talk about loan products. You know at Florida Funding we offer a lot. The only thing we don't offer is construction and land only. Pretty much everything else is we've got an outlet for. So let's back up to, I think HomeLight was here earlier, right? So HomeLight's cash only product and their trade-in product are good products, and that's of course something that we can't offer as brokers. So yes, if you've got a buyer that fits their buy box, definitely send it to them. I would encourage you to also send it to Florida Funding so we can approve them at the same time. Because if they don't fit in the buy box, or it ends up not being a good fit, or they can't approve them for the cash only or trade-in, we're already that far ahead in the approval process, so you're not starting over. Your client's not waiting that 5 days to hear from them. We've already got it going. And listen, if that's a better deal for them, we're gonna tell them. Hands down. So we're here for the client. We want to make sure that they get the best deal. We offer a lot of different programs. Gary and I are going to hit on a couple of the non-QMs. So remember I said the exotic loan structures are out of the market. feel their pin creeping back in, and they started in about, what, 2020, coming back in, maybe 2021? So the difference is, so you can't just fog a mirror to get a mortgage. You still have to be able to prove that you can repay. So what's, the underwriters, what's their number one job? Can this client repay the loan? That's what they're trying to prove. If they can prove that, based on history, based on credit, all the other factors, they're gonna approve it. Investor cash flow.
All right, so with this is typically referred to as a DSCR loan, debt service coverage ratio loan. And really what they're doing is they're just seeing what the property on a rental basis is gonna return. And typically they wanna see 1-to-1. So if you can rent it for $2,500 a month, and when you make your down payment, we're able to get the payment to $2,500 a month, it's gonna be an approved file. There are lenders that will actually violate the 1-to-1, and that'll be an add-on to your interest rate. So the way I would look at this is if you have an investor who's not gonna qualify under traditional income verification, then if they've got 25% skin in the game, they're more than likely gonna be able to get a loan. They need to have reasonable credit to qualify for that.
They do not have to have any other income because the income is coming from the property. So you might have some investors that is their income, is what they own and what they invest.
So this is a good program for investors. We have a lot of investors out there have more than 25% put into it.
Yeah.
You know, well, you get the rates higher, but hey, you're an investor.
Yeah, exactly. And some people just don't even have any other option.
Yeah.
One thing I want to point out here is that they do have to own a primary residence in order to participate in this program. So,
You can actually violate that too, though.
Yeah. And they can do Airbnbs. Look,
right.
how many people call you all the time? I want to do an Airbnb.
Non-warrantable condos are allowed in this program as well, so.
How many units could one, I mean, let's say you have for a quadplex, could you do something like that?
Can you do a fourplex under a DSCR loan? Yeah, you could do a fourplex.
They need 20% down for this?
No, in the DSCR loans are gonna need a 25% down
25%,
payment.
sorry.
And then you get into what it really is a debt coverage loan. So if it's not covering the debt, then there's certain circumstances with great credit that you're allowed to violate that, but, you know, at an increase to your interest rate. With not as good credit, then you're not gonna be able to do that.
So if we're in this program and the appraisal comes in lower, the rent survey comes in lower, 1007, the rent schedule, what I'm trying to say, on the appraisal, we may have a problem. So try to do the research beforehand and make sure that we're there, but you know how appraisals go.
And those rent surveys are based on long-term rates. The only way that an investor will allow for you to use short-term rates is if they have documented proof of what that property is generating in short-term income.
And there's already last year schedule that shows.
Speaking about Airbnb.
So if you're buying an Airbnb for an Airbnb, that's already an Airbnb in place that has a history of collecting those amounts. It's doable.
Yep.
The reason the primary residence, the borrowing of primary residence, is that for security or just for some other?
I'm thinking that's a risk profile. They've determined that somebody who doesn't own a residence is just getting involved in this is probably not gonna have as successful of a ability to repay that loan and service that debt.
And even with a lot of investment properties, they want to see that you've got some experience in rentals.
But the primary doesn't have to be here in Florida.
No. 680 credits per min on this, I think?
Yes, I think 680 is the minimum on most of these types of programs where we're not verifying stuff.
Yeah. Community mortgage, I'll let you take this one too.
This is actually a really cool program. I've done a few of these recently, and the nice thing about this is we're not verifying income or employment, so neither. And your client needs at least 20% down payment, and that's going to require a 740 credit score. 25%, I know I see the 640 there. 25% is going to require a 680 credit score. They will go down to 640, but you need a massive down payment to get it there. I don't know off the top of my head if it's 30, 35, 40%, but it's one of those numbers. The benefit to this is, let's say you have somebody who is in another state, and they want to relocate to Florida, and this happens all the time, and they don't have a job. They got a job up where they're at, and they don't have a job here. Doesn't matter. We can get them into the home as long as they have the down payment and credit score to support where they need to be at. The one caveat to this is you need reserves. You can't just barely have the money. You need reserves post-closing, a minimum of 12 months of debt service. So if your monthly housing payment is $4,000 a month, you need $48,000 in your bank account after closing to qualify for that loan program. This one is really, to me, this one's a game changer. The interest rate's not great, but trust me, people who realize they don't have employment and income and they understand that, they don't care that they're gonna be paying in the nines for a year or two because they're gonna refinance that loan. The person who had the job in New York that's relocating here, that's gonna come down here and search for a job, at one point in time, they're gonna get that job and then they're gonna refinance this loan. The other benefit to this is it's only primary residences and second homes, so there is no prepayment penalty.
This would be great because a lot of those people from New York and stuff, they sold a $750,000 house. They come down here and buy it for $400, $500. They have the money, you know?
And typically, I mean, if you have that scenario that we already talked about, and we're going the conventional route, and we're waiting, we get an engagement letter, we're waiting 30 days, we've got to get a pay stub, maybe 2, depending on the lender. So this really just cuts all that out, and it opens up a lot more doors for a lot of people. So again, some of these, no income things are coming back into play, no income verification,
Yeah,
but
type-
now you got to back it up with money. Sorry, go ahead.
No, Chris was asking if it's a 30-day close. I like to defer to being conservative with closing dates, and anything that's a normal loan, we're definitely closing that in 30 days. If it's a non-QM product, I would rather you negotiate a little bit more time. Otherwise, if we need to buy 3, 4, 5 days, you guys are gonna have that battle down the road, and it is what it is. Like,
Shoot for 45.
yeah, I think that if you can buy a little bit more when you're dealing with a non-QM product, it's better, so that you don't have to then have that battle down the road, but whatever works best and you get the deal done, that's what's important.
And we closed it in 30 days, but
Yep.
I agree with Gary on that. Anybody heard about 2-1 by now?
No.
Seriously? Does anybody know how to calculate how much seller concessions you need
2.3.
every time?
I think one of the flyers you sent us at 2.3, so I just.
So this is the math. You're basically taking the qualified rate, which is 7%. So the savings in the qualified rate and the first year's rate, the annual savings, plus the annual savings on the second year rate, that's gonna be the amount of concessions that you need. So I'll send this to you, Chris, so you can, if it helps. You're right, it is anywhere from 2 to 2.5%.
He sold his bike.
Thanks, Robbie. Thanks, Robbie. One thing that you may not know is if the buyer decides to refinance before those 2 years is up, they do get a credit on that money. So it doesn't just go back.
I would make a point on that. If you're able to negotiate a seller concession, you're always gonna be okay with a 3% seller unless it's an investment property, because then you're capped at 2. But if you can negotiate a 3% seller, you will always be able to cover a 2-1 buy down, and that extra money will go towards their closing costs.
So everybody talks about 2-1 buy down, but there's several options. So let us handle that part to figure out what's right for your buyer, but know that there are more than just a 2-1.
That's for 3%. I think it'd be good.
Yeah.
Yeah, the 3% will get you everything except for that 3-2-1.
Yeah.
And then, so with seller concessions, just so everybody knows, if you're Fannie Freddie conventional and you're over 90% loan to value, you can do 3%. If you're between 75 and 90, you can do 6%. If you're under 75% loan to value, you can do 9%. Never seen one, but you can. If you're FHA, it's 6% no matter what your loan to value is, and if it's VA, it's 4%.
We should put something together and send that out.
Yeah.
I just call them and ask
Just
them.
call me.
How much can we
Just ask for
get?
those stuff, so, yeah, just call Gary. But no, this is obviously, a big buzz right now about this and another way to help combat I think that you said to help combat that interest rate reduction. Obviously, you can get a seller concession for a permanent buy down. I think you guys all know how that works. We can use that, back to the 2-1 buy down or the buy downs. Make sure that you put that in the contract, that that is what the money is gonna be used for. I would put it on an addendum. In case we change our mind. We do have first-time home buyer programs. I put this in here because we get this question all the time. So yes, actually, Fannie and Freddie just changed their guidelines on this, so it makes it more affordable for a lot more people to qualify for a first-time home buyer program. They go off the median income of the area on some of these programs, so they just raise that level. So again, a lot more people are gonna qualify. So, 3% down, it's conventional. We do quite a few of them.
You have access to some programs that provide down payment assistance too.
We do not participate in the county or state down payment assistance programs.
I mean, like Shinola Fund or something.
We do have options for the Chanel's, yeah. So that down payment assistance program, if you don't have seller concessions, it rarely works. Because a lot is, let's just say it's 5% down payment assistance. We take a lot out of that 5% before the rest of it can go for closing. There's typically not enough left. So seller concessions will help close that gap. So yeah, we definitely look at that. Definitely look at that. This is our team. Super happy with our team. We have, everybody on here is pretty experienced. I think you and Shannon are probably the most experienced. And Colleen, I don't know. I can't keep track of how many years y'all been doing this. Longer than me, because you're older than me apparently. But yeah, you guys